a very good evening to all of you all. So thank you for joining us tonight. So tonight's webinar will be actually mistakes to avoid when investing in REITs. So this will actually feature Josh. Josh is the founder of the Astute Parent. So it's a rather popular website and also his YouTube channel, whereby he provides some finance knowledge and also market know-hows. And co-chairing the webinar tonight will also be Sebastian. So Sebastian heads distribution here at Syfe. So he's actually the one responsible for you guys seeing all the ads and all, right? So maybe we just give it's 7:03 already. Time flies. So shall we begin? Josh and Sebastian?
Yes, definitely. Good evening, everyone, and welcome to our session tonight. I think, Josh, you have prepared a couple of slides for us. Do you want to take it away?
Yes. Thank you. Thank you, Melvin. Thank you, Sebastian. Okay. Yes, I do run a YouTube channel, and it's actually quite hard to build a YouTube channel. And I managed to persist so far, I guess, because I really love talking about investments. But today you're here and we're talking about REITs. So hopefully you can walk away from this discussion with learning points that you can, put into practice in many ways. And just to share a bit of fun fact about myself, I used to prefer investing into property counters, property stocks like CapitaLand, like Guoco Land, like City Development, because these local property developers, they seem to be below book value. But unlike REITs, REITs usually they hover around the one times book value. I used to think property developers seem to be a better option. But fast forward to today, I actually changed my portfolio direction very drastically. You do see quite a lot of REITs within my whole net worth. So that's something I'd like to share with you. Something for you to consider also for yourself, especially if you're looking to invest for dividends. Now, if we were to understand the local markets a bit better, you'd see that STI right now has quite a few REIT counters within it. You'll see, of course, your CICT, your Ascenders. There are actually 6 REITs within STI component already. And actually, an interesting fact is actually on the reserve list, there are further names like Fraser Centrepoint, Fraser Logistics, like Suntec REIT on the reserve list. So, and recently, Capital DC REIT has been promoted to STI component also. So the main thing is, increasingly, we are seeing REITs forming a bigger component within STI. So you think for yourself, is this a mega trend? Do you want to be on the right side of change? Is it always going to be on banks, or is REITs going to be increasingly important, especially in the Singapore landscape? If you think about it, Singapore's growth is not likely going to come from oil and gas. It's not likely going to be telcos. So where is it going to be? If it's REITs, you want to invest in REITs, today's discussion really helps you on it. Now, this first slide that I'd like to really help you think about some points for your own investment. Is REIT investing all about buying the right sector? Think about it. Because if you kind of were thinking what is the best REIT to buy and you have gone into hospitality REITs, you realize that everything on that list is red because COVID-19 hit in 2020. And every counter that's a hospitality REIT also suffered in terms of performance. So is it really buying the right sector? That's something they need to think about. Is it as simple as buying the right sector? So if we move on to the next slide, then you realize that maybe there are more defensive sectors like healthcare sector, because healthcare is, as we know from COVID-19, something that is indispensable, something that is thought to be stable. So in terms of healthcare REIT, there's also something very interesting to highlight it within this red box over there. You see two prominent names within the Singapore REIT space. First REIT as well as Parkway Life REIT. And you realize that performance is drastically different. One is minus 75% and one is 21%. So if you've gotten a company wrong, you've been vastly different in terms of performance. A $10,000 invested in First REIT, in 2020, we have lost 7,005, remaining only 2,005. But an investment of 10,000 in Parkway Life REIT, we have grew to 21,100 to 12,100. So is it really buying the right company? Is it as easy as buying the right company? So think about that for your own investments. So if we move on to the next slide, you'll be thinking, it's obvious. It's definitely Parkway Life REIT as a better bet. But this chart that I've prepared for you is actually to show you First REIT's past performance. This is from 2010 all the way to 2015. The green shaded area is First REIT. It actually outperformed Parkway Life REIT quite substantially if you're looking at a time zone of 2015, 2016. That goes to show you that, past performance is very difficult to indicate things. If you buy an investment based on price trends, you can also get things wrong. So that's a mistake that you need to keep in mind also. So if you move on to the next slide, is investing the REIT as simple as buying based on recommendations or based on target prices? Now, as I've showed you already, First REIT's performance in 2020 was pretty bad, correct? And if you look at a research report that's published, this was as late as August 2019. Nothing was flagged up that First REIT was potentially in trouble or their business has risk to it. The recommendation was an ad. The target price was something higher. So is it as simple as looking for recommendations and looking at target prices? So you have to think very carefully. Is it as simple as that or not? So if we move on to the next slide, is investing the REIT buying a REIT that has steady dividends? Something that First REIT's case study really shows to you is that even for a company that has a fairly decent track record all these years, you would see in this chart every year performing consistently, but the underlying risk was not highlighted. You realize that if you're purely based on past dividends, you might also get into picking a REIT that is not going to perform well moving forward. It also shows that if you buy REITs based on dividend yield, you're also not looking at the risk correctly. So this is a very important learning point. So is it buying REITs with steady dividends that get you good performance? So think about that also. So that's a key fourth point. Now, what is important to you? So if you think about it, there's so many things that you can get wrong. You can get a sector wrong. You can get a company wrong. If you take a recommendation, you read widely, you can still get it wrong. Why not diversify and get a whole basket of REITs? And that's what Syfe REIT Plus actually delivers. The box that I've shaded in yellow over there are the top performance for REITs in Singapore. But the main thing is buying these top performers is very difficult to pick on hindsight. But if you get a basket of REITs, something that is well run, well managed, you realize that you get exposure to the best performing REITs itself. And what ultimately is important to you is consistency in performance, as well as avoiding terrible mistakes. And that's the whole idea of getting a whole Syfe REIT Plus portfolio. Now, I've actually a further bonus point, which is the next slide over there. So this is something that because I run a YouTube channel, and some of the principles that I share very frequently. When it comes to stock investing, there's this common mistake, especially when First REIT had trouble. A lot of investors were searching on forums for recommendations and ideas on what to do. When you buy an individual REIT or an individual stock, you're at risk of catching a falling knife simply because we don't know how far a stock price of a company can fall. It can fall really to zero or get suspended even. So this really shows that if you buy a particular REIT and particular share and you get it wrong, you're at this dilemma of should you average down or not. But if you buy a whole basket, you do know that you'll never go to zero. You have diversified. Sometimes performance is bad due to market sentiment and due to certain other reasons. But if prices come down when you buy a whole basket, you can be confident in moving ahead with your strategy, especially if you're using, for example, a dollar cost averaging strategy to buy into a REIT portfolio. Then if prices come down, you can actually take action and continuously buy and sleep well on it. So that's a key point. If you buy an individual REIT, you have this dilemma of whether you're catching a falling knife. But if you buy a basket and performance starts to come down, that could be opportunities that you can actually tap on. So these are 4 key points that I would like to leave you to take away from this discussion. Is it really easier to pick a REIT? Or are you better off if you believe REIT is a sector like what I showed you? Oil and gas is not going to be Singapore's main sector. Telcos is unlikely to be the shining light in the future. Then if REITs is the solution that you're looking for, then maybe the portfolio delivers what you're looking at. So with that, I'll pass back to Sebastian and Melvin. Hopefully it's impacted you in your train of thought and you can invest a lot better into REITs.
Thank you, Josh. I think that was very, very interesting, and I think all of us could learn something here. I think I don't want to take too many questions right now, but maybe there's one question which came up. One of the viewers saying, not familiar with First REIT. What was the main cause for them losing 75%? Maybe if you could just share this in one or two sentences.
Sure. So actually, when First REIT, as what I've shared, is actually owning hospitals, correct? So when we think of hospitals, we think private hospitals earn their profits by taking care of emergencies, but that's actually not the case. Private hospitals make their money taking care of elective surgeries, for example, Botox, for example, things that can be postponed. So when COVID-19 came on, you realize that actually the private hospitals are not seeing business itself. That's the same even for Singapore. First REIT has certain underlying lease issues also. That is a big topic. But it goes to show when you buy a REIT, there's certain risk involved. You need to understand where is the tenant concentration, for example. What's the sponsor's support for the REIT, for example. So there are a few underlying factors, but mainly COVID-19 was a big hit to the overall operations of First REIT. That contributed to the downfall.
Great. Thank you. I think the questions regarding which are more REIT plus specific, I'll probably will take in 1 second, but maybe one more, which is just a more generic REIT market question, which has come in, which is like, so if you is asking, is it wise to reinvest the dividend or to cash out under these circumstances, right? We will see later on that, Syfe REIT Plus basically gives both options, right? But is there a recommendation you have for this particular viewer?
I think the reinvestment portion really depends on your use for the dividend. Most often for non-retirees, the better choice is always to reinvest because you want to compound your returns, correct? So if you're working towards your own retirement, you should always be looking at ways of compounding. You get a dividend, you reinvest it back, then you get a compounding effect. If you're a retiree relying on the dividend income, then that's a different story. You require that income for your circumstance. So it really is dependent on circumstance. It's not really the investment or the stock itself.
Perfect. Thank you for that. And I think, yes, this is also what we see, right? That actually dividend reinvestment really helps to actually boost the dividends, boost the returns overall, right? Because this will, as you said, compound the returns, right? Great. I think there's a couple more questions which came in, but before we answer those, I think there's two more sections which we have. We have a very quick introduction to Syfe for those who are really new to Syfe, and then we will go into a few slides about REIT Plus specifically. There is already a couple of more questions coming in, but we'll answer them in a bit. For those who haven't yet asked any questions, please feel free to use the Q&A button, which you see somewhere on your screen, where you can very easily put your questions. All right, very quick introduction onto Syfe. So Syfe was incorporated in September 2017, based here in Singapore. In July of 2019, so a bit more than a year and a half ago, MAS granted the CMS license, so a fund management license, and Syfe publicly launched with their global portfolio. Over this year and a half, Syfe has launched, I would say, 5 different key portfolios, and we're gonna see them in a bit more details later. But also have launched a service of wealth experts. We are providing basically access to these wealth experts who can give a bit more, like individualized consultation about our products. We have by now about 60 people from various backgrounds, from banking and finance, as well as some like technology companies, such as Lazada or Skyscanner. So it's a mix combining and marrying those two industries. On the right side, you can see some of the management team. There's Drew Farrar, who many of you would also know from some of the previous webinars we have done. He spent many years with UBS. And then there's Richard Ye, who is our head of portfolio construction. A lot of you might know him from the investment strategy deep dive sessions, which he does on a regular basis. As I mentioned, we are licensed by the MAS with a retail fund management license. This is one of the one of the licenses with the most stringent requirements, because it allows us, it allows retail clients, individuals like you and me, to basically invest. In addition to that, we are also an exempt license for financial advisory. And I think what's also important is that all the funds are always held with custodians, meaning like after we have purchased the securities, they're either held by Citi or HSBC in order to protect them. And when you initially fund your portfolio, then you're transferring to a DBS trust account, which is only for portfolio assets and is not used by Syfe for any other purposes. That said, I mentioned there's a range of products. Today we're gonna be focusing on REIT Plus, and that's why I don't want to talk too much about this right now. I'm just gonna give 1 or 2 sentences for each of the other portfolios. We have a so-called cash management solution called Cash Plus. This is a product which gives higher returns than a bank savings account by investing into low risk bond products, such as a money market fund, an enhanced liquidity fund, and a short duration bond fund. And by doing so, with low risk, you can achieve a projected return of 1.75% per annum. There are no lockups, no limits, no maximum or minimum. And actually, we are not charging a management fee for this product. We have separate sessions on all of these different portfolios. So if you're interested in one of those, either check out our website, sign up for one of the webinars, or also feel free to schedule a call with one of our wealth experts to learn more. Then we have recently launched a so-called core portfolio, which is all about risk-adjusted return maximization. So these are diversified portfolios across equities, bonds, and gold, or commodities, in our case, mostly gold. And there are 3 different portfolios. There's a defensive, a balanced, and a growth portfolio. So depending on your objectives, you can choose between those 3 portfolios, or also invest in all 3, depending on, so you have a different portfolio for different objectives. And then we have the global ARI portfolio. So these are downside protection portfolios. So that basically means you choose a risk level, and the ARI algorithm basically makes sure that you never take more risk than what, like your portfolio has never more risk than what you have decided. Yeah. There is 11 different risk levels available, so you can really decide exactly what you want. And then for those who are looking at a longer investment horizon, Equity 100 is probably an interesting solution, which is a pure equity portfolio, really like focused on growth, investing in more than 1,500 different stocks across the globe, and applies a smart beta strategy. So it tilts towards certain factors, namely large cap growth and low volatility. I know this was a fairly quick overview of the different portfolios, but I'm happy to answer questions later, or alternatively, there's a lot of information on our website available as well. So with this, we come to the one portfolio which we have skipped on this overview, which is the Syfe REIT Plus portfolio. This we actually developed in partnership with the Singapore Exchange. So it tracks the IHS REIT Leaders Index, and it basically gives you access to the largest and most tradable REITs in Singapore. Let us go into a bit more detail. As I just mentioned, the index is created by the IH team of SGX. And the index contains about 26 REITs out of the 44 listed REITs, if I'm not mistaken. It focuses on a mix of both. So there's an opportunity for capital appreciation, as well as attractive dividend yields of 5.1% in 2019. In 2020, it came down a bit to about 4.5%. And so they choose the largest REITs, the most liquid REITs, so meaning those where there's the highest trading volume, so which makes it also much more efficient to buy. But there are also other factors the IH team considers when creating this index, such things as free float, the velocity, and there's also a cap, so that no single REIT within the portfolio or within the index can be more than 10% of the index. A couple of examples. What is in there? Or let me, before we go into the example, I just said there is a cap of 10%. No constituent of the portfolio can have more than 10%. Why? On the next slide, immediately I show that there's Capital Land with 19.8% of the portfolio. And the reason for this is that there was a recent merger, right? So two of Capital Land's REITs actually merged, and that's why they have a larger share of the portfolio at the moment. When with the next rebalancing, both the Capital Land Integrated Commercial Trust as well as the Mapletree Commercial Trust will both be basically reduced to a 10% share, as this is part of the way the index is created. I think basically all the household names are part of the portfolio. So there's Suntec, Capel, Ascenders, Mapletree, Capital Land, Frasers, and so on. And they own and operate many of the residential, office, and commercial buildings all of us know and appreciate here. Plaza Singapura, Bugis Junction, or as I mentioned, also office buildings such as the Changi Business Park or Mapletree Business City. Before we come to this, I saw there's a lot of questions coming in. Should we take a quick break and answer a few of the questions, Melvin?
Yep, sounds good. I think some of the questions are really good. I think it will help explain some of our points as well, right? So one question is, how are the REITs in the Syfe portfolio selected and the percentage of allocation decided, right? So
yes, it's an excellent question, right? So in the case of the REIT Plus portfolio, the asset allocation is decided by the index. So we are replicating or tracking the index. So it's the IH team which basically decides on what percentage goes to which of the REITs. Yeah, as I mentioned earlier here, there's different criteria, right? I think one of the main criteria is obviously the market capitalization, right? So how big is this specific REIT, right? And the bigger a specific REIT is, the more, the higher the share will also be within the REIT Plus portfolio, within the index. But at the same time, there are also a lot of other important factors. And I think I mentioned already a few early on. The one which I did not bring up is the last point here, so that the IH team uses something called FactSet's RBIC classification system, right? And this is something highly complex, and we have actually a session usually around every quarter where we invite the IH team, where they go into a bit more of these details. But it's basically, I think, to summarize what the index tries to achieve is, the index tries to achieve, to allow people to invest in the real estate sector in Singapore, right? And it optimizes so that there is, so it optimizes for certain factors which objectively are enhancing the portfolio, right? If the free float would be too small, it does not make sense, right? Because then it means for a lot of different things can impact the share price, right? If one particular REIT becomes too much of the portfolio, then it's also, there's no more diversification. That's why there's a cap of 10%, right? So there's a lot of good criteria they put on top of the market capitalization to make this index a very strong one.
Good. So thank you for the answer. So maybe one for Josh. Right. So there's a good question as well. Personally addressed to you, for Josh. Do you invest in Syfe REIT Plus? What do you think about it?
Oh yes. Okay. Quick answer is yes. I do have the Syfe REIT Plus with the risk management one. But as always, what I like to share, my own strategies. You should choose your own strategies based on your circumstances. So rather than taking what I do and replicating it, decide for yourself what fits also. I can also share a bit further. I do own certain individual REIT names. But also I realized when you own too many REITs, there are a lot of corporate actions that you need to participate, like rights and stuff. So having the Syfe REIT Plus gives me the whole basket. Then I do pick a few. I try to limit the number of REITs I own individually to reduce all these corporate actions kind of procedure. So that's the real benefit that I believe Syfe REIT Plus actually delivered for myself. So hopefully that answers your question. But again, find a fit that works for your own financial goals.
All right, thank you.
I think that's a very good point. So sorry to jump in there, but I think that's it's also something which we usually recommend when it comes to the Syfe portfolios, right? To have some kind of core satellite strategy, right? Which is, you have your core in a very diversified portfolio. So if it comes to the Syfe universe, you often, of course, talk about the Syfe core portfolios, for example, right? Which gives you exposure to really equities all across the world, including China, US, Europe, and so on, right? And then you have satellites where you express your own views, right? They're okay. In Josh's case, maybe you believe in a specific REIT that will do better than everything else, right? But it could also be that you have a core portfolio and you say, I genuinely believe in the Singapore real estate market, and then your satellite is simply a basket of REITs, right? So you can go into a lot of different layers, right, and can become very granular. But I think that the approach is the same, and I think makes a lot of sense.
Great, thank you, Sebastian. So do we take a couple more?
Yes. Let's. I think there's quite a few questions, so let's try to answer a couple more before we go ahead.
All right. So since we are on this page, another interesting question is the outlook for office REITs. Right. It's rather gloomy, according to this anonymous attendee. So work from home will be here to stay. So long-term wise, this could essentially be the new norm. So how will this actually affect the Syfe REIT portfolio? Who's going to take it?
Yeah, I think that's a I think it's a great question. I think there's a couple of points to that. One is just I give one example. Like we as a company, right? We are just like we have been working from home for a significant time now as well, and we are now moving actually back to the office and to a very like much bigger office than we used to be. So I think there's more and more companies who will again move back to the office because there is still advantages of also having face-to-face interactions. But the other part is that there is just limited space here especially in a country or in a city-state like Singapore, right? So even if it's the case that work from home is here to stay, then people want to have bigger apartments, right? So and you know, and these owners or like of big properties, right? They are creative, right? If they will see in the long term there's less demand for office, then they will turn them into other kind of projects, right? So yes, maybe in the short term, office REITs have done a little bit less good than some of the other categories, right? And the same thing applies to commercial REITs, right? Shopping malls were empty for a long period of time, and they came back again, right? But people will find new uses for property if the demand is lower for medium to long term, right? And this can be many different things, right? This could be that people want larger apartments because they're spending more time at home, but this could also be other things such as like you know, like we are more and more relying on e-commerce delivering to our house, right? And we want it to be even faster. So some of the office real estate in the could even be taken up for mini warehouses, which allow a faster delivery, right? So there's many different use cases, and I think we at Syfe are quite bullish that this is a sector which in the medium to long term will do very well.
Or maybe can I jump in and add a quick word also? I do agree. Commercial REIT managers definitely will be thinking of how to adapt. But answering back that question, whether you know the outlook now is gloomy, maybe we need to think again. Are we focused too near term? Because right now what we are so hung up on is the current work situation, the current pandemic. But if you imagine 5-10 years ago, we really don't know. We could have solved the pandemic issue already. We could have resumed fully already. So also avoid looking too near term in that sense. So we are putting a lot of assumptions that this is going to be the norm, which may not be the case. So always think very carefully whether that assumption is 100% true or not.
Yeah, no, I think that's a fantastic point, right? I think these portfolios are for you know, it's not a short term, should not be a short term trade, right? But really an investment, which means we look at minimum of 3 years, 5 years, right? And in many cases, much longer, right? Great. Melvin, questions keep coming up faster than we are able to answer them.
Correct. So maybe let's take a couple more as fast as you can. So one from another anonymous attendee: the Syfe REIT portfolio with risk management allocates more to bonds in volatile periods. So shouldn't investors be buying more of REITs instead of the bonds on these lows, example right now, instead of balancing towards bonds?
Yeah. I think this really depends on the risk appetite, right? The ARI, right, which is the automatic risk managed investing strategy. What it does is basically every single day, thousands of simulations are being run on the portfolio to check what is the risk of this portfolio. What are, you know, like over the next year, what could potentially happen, right? And based on this, will actually increase or decrease the share of bonds, right? Ever since the pandemic started, or the pandemic hit the stock markets in February, March of last year, the volatility is very high, and risk and volatility are quite closely correlated. So that means ever since the bond share is relatively high, right? So this has helped, people a lot, in the time when it really dropped, making the portfolio more resilient, right, against this drop. But of course, it also meant when it recovered, that the recovery was much lower, right? So if you are an investor who, for example, does dollar cost averaging, then probably 100% REIT portfolio makes more sense, right? Then you do almost your own risk management by putting in equal amounts or by frequently putting and depositing amounts, right? Then probably a risk managed portfolio makes less sense, right? If you're putting a very large amount or a lump sum into it, then this can make sense, right? And if you know that your risk appetite is lower and you probably are panicking if there's a market correction, right? For people who can stomach a bit of volatility or who DCA into their portfolio, I would think that probably a pure equities, pure REIT portfolio is probably better suited.
Great. So thank you, Sebastian, once again.
I think there's one question I saw, which is if Syfe allows to see the individual performance of each portfolio, and the answer there is yes. So you can create multiple portfolios, even of the same type. So you could create, let's say, 3 different REIT Plus portfolios, right? Because you have maybe different goals, right? And you can, each of them, you'll see on a daily basis, you'll see the performance of this portfolio.
So another one could be a good one to answer is that what's the difference between the 100% REITs and REITs with risk management in terms of dividend yields? So this one we have the data. So I think the variance between the two dividend yield over time is not big. It's not too significant as well, right? So correct. This is the slide that will address this.
Yeah. Maybe as we already jumped to this slide, maybe let us talk a little bit about the REIT Plus performance. Let's focus first on the table at the bottom left, right? And here we show trailing returns on an annualized basis, right? So as you can see, the returns over the last 3, 5, 8 years are actually very good, right? So this is annualized. It means over the last 5 years you would get 10.6% on average every single year, right? In 2021, right, there was a bit of a choppy start into the year, so we are roughly flat, or like 2% and down. And there, even the risk managed REIT portfolio is pretty much down the same level, as also the bond portion was affected, right, by with rising yields. The prices of bonds got affected negatively. I think where you really see the difference is on this chart above, right? On 2nd of March, so the blue line is 100% REIT, right? So it is always 100% just the REITs. The REITs' risk management has between 50 to 100% REITs, but 0 to 50% can be bonds. And this is decided by ARI, which is Syfe's proprietary risk management algorithm. So on the 2nd of March, when volatility increased, the share of REIT dropped from 77% to 50%. And suddenly then there was the big drop. And because the REIT share was reduced the drop of the risk managed portfolio is lower than of the 100% REIT portfolio. So this is obviously great, but you can also see that then over the next 2-3 months, the 100% REIT portfolio would have recovered faster than the risk managed portfolio. In terms of dividend yield, as Melvin mentioned, the similarities are relatively small if you go back a couple of years. Right now, the difference is a little bit bigger because bond yields are generally very low. So the part which is currently invested in bonds deliver a relatively low yield. So you have a 4.5% on the 100% REIT portfolio and about 3.25% on the risk managed REIT portfolio. Historically, like if you look back a couple of years, it's usually actually above 5% for actually both options. I would then go quickly to explain here one more time the differences. I already brought it up on the other slide, but 100% REIT portfolio again is just exactly tracking or very closely tracking the S-REIT Leaders Index. Yeah, pure REIT portfolio. But you can also opt for a risk managed REIT portfolio which combines this with Singapore government bonds, right? And this basically helps against volatility, right? The growth of the portfolio will be more stable, right, and will be less volatile. The share of bonds is not fixed, right, but will vary depending on the risk or on the volatility in the market, right? So there's up to 100% REITs, but it's never below 50% REITs. With this is basically we are done with the presentation on REIT Plus, but I think now we have to answer all of the remaining questions.
Great. So maybe one for Josh actually. So reaching towards retirement and looking for a portfolio that would return dividends in short term, which portfolio should he or she be looking for or looking into?
Oh, hold on. Reaching dividends with. Okay, so it's between the REIT Plus as well as the REIT Plus with risk management, is it?
Yes, I am assuming this one will be talking about REITs only.
Between the two REIT Plus portfolios. Then it definitely would. Okay, maybe I would. Okay, for retirees.
I think before we answer this question, I think one important part is that we don't know the individual situation in detail, right? So it's for us, it's very hard to give a definite answer, right? And you should always consider your individual situation. You can reach out to one of our wealth experts who can describe a bit more of this individual situation, right? So I will hand back now to Josh, but to share his opinion. But it's hard to give a very specific answer if you don't know all the circumstances.
Yes. I was actually stuck at a point which is very true. Your individual circumstance, because if not, we'll be generalizing it. So definitely speak to someone if you're unsure. What I can impute is, especially if you have not invested too much before, you need to consider whether you are comfortable with the right size of portfolio, as well as if it's fully REIT Plus without risk management. Because as we have seen in March 2020, the portfolio can swing. So as a retiree, I think you want dividends, you want to sleep well, knowing that the capital is not moving too much. So these are some thinking points, whether you can tolerate that risk. And beyond that, probably speak to someone to customize and go through certain scenarios. So that would be my best answer for it.
Yeah, I think that's a very good answer, right? I think especially for someone who is new to investing, right, and who has never seen maybe a 10% drop or more, right? I think it's probably risk management really helps there to limit this short-term temporary losses, right?
Yes.
Where beginner investors need to learn that sometimes you just need to then stick with it and ride it out. There's another interesting question by Kim. Why should we choose Syfe REIT as compared to buying ETF directly from SGX? So the very short answer is that there is no ETF tracking this specific index, right? There are REIT ETFs obviously out there, but one, they are not tracking this specific index, but they follow other things, as well as you need to consider cost, right? And actually, let me jump to, I think I have a slide there. Yes, and this is not specific to REIT Plus, but I think it applies also to this to REIT Pluses. With Syfe, you basically, yes, you have a management fee, but it's between 0.4 to 0.65%. Even ETFs charge a similar amount. But on top of the management fees, you will have brokerage fees when you buy directly from the exchange. And you will have them not on an annual basis, but every time you buy or sell, right? So brokerage fees, here we say 0.4%, two ways, so when you buy and when you sell. But actually, it can even be much, much higher than that if you buy smaller amounts, because most brokerages have a minimum fee. So let's say if you invest with DBS Vickers, you basically will be paying $25, I think, if I'm not mistaken, every time when you buy or sell. If you buy a large amount, then this will not matter that much. But with small amounts, this is a very big part. Yeah. Advanced risk management. Usually, I'm not aware of any ETF which offers this. Rebalancing and optimization. Yes, certain ETFs will rebalance for you. Automatic dividend and reinvestment. ETFs, most of them are distributing ETFs, so they will basically distribute the dividends, which means, you know, even if let's say if you invest $10,000, right? If you get 5% in dividends, that will be $500. To invest $500, especially into, you know, like, you know, it's not that easy, right? And that's the whole dividends you will get throughout the year, right? If you then have a $25 fee to buy the ETFs, to buy the ETF, then it doesn't really make much sense. One other additional thing is actually Syfe doesn't require you to have a CDP or brokerage account, and the time to sign up is actually very, very quick. You use my info and you'll have an account in about 3 minutes. I hope this answered your question, Kim. Melvin.
Okay.
What other questions did come up?
Okay, so one question, right, is why Syfe can buy partial amount of stocks, right? So this is one of the benefits of using our platform, whereby investors are not restricted by lot sizes. So why can Syfe, you know, allow fractional shares?
Yeah, no, that's a great question, right? So we basically use the same technology as let's say some of the brokerages as in the US. I mean, one of them would be like you know, Robinhood and so on, right? Where you basically are able to hold what's so-called a fractional share, right? And why we can do this is our proprietary fund management system, which we have, which we developed, right? And which basically allows that an investor who invests $1,000 and an investor who invests $1 million will have exactly the same asset allocation, right? The difference is just that the one with the smaller portfolio will hold just fractions of a share, right? While the larger portfolio holds many units of every share, right? And of course, we as Syfe have to buy the full unit, right? But then we can basically split it up across different portfolios, and this is basically allowing investors to have, you know, like the ideal portfolio regardless of the size and the amount you invest.
Okay, thank you. So one more. I want to add to my REITs Plus portfolio. So this question is by Sandeep. So is it a good time or should they still wait out? Right. So I think this is on everybody's mind.
Yeah, I think this is a question where Josh and I both can share our perspective. And we at Syfe, we don't really believe in timing the market. We believe it's mostly about time in the market, right? There is many there's a lot like research and so on, which basically has shown that it's very difficult to get the timing right. Who would have thought 1 year ago that COVID-19 will come and you know, and this pandemic would have such a big impact on the world, right? No one could have really known this before, right? There's other events which could be similar, but they could not affect the REIT market, but other markets. So it's very difficult to really get the right timing. So what we believe is it's important to start investing, to be able to have time in the market, because if you're long enough in the market, you will see positive returns. There is a study which looked at the returns over the last 160 years in the US equity markets. And if you invested more than 15 years, there is actually no period within the 160 years where you would have actually lost money. If you only look at individual years, there are many years within this 160 years where the stock market went down. But the longer you are invested, the higher the chances that you will actually make positive returns. And as I said, I think above 15-16 years, somewhere there, there's not a single period where you would actually have lost money, because over the long term, stock markets basically have gone up consistently.
Yeah, maybe I can add a little bit further. I agree a lot with what Sebastian has mentioned. But also to Sandeep's question, is it a good time to invest? Actually, if you think about this question, right, maybe Sandeep, you're thinking, how can you invest without losses? Because that's the real core of what you're asking. Is it a good time to invest? Is actually equated to, can you invest without losses? Because you're thinking about the timing. So to understand it, no one knows whether it's the best time today or next week. But if we believe that this asset class that you're buying right now is going to be at a higher price 10 years down the road, 5 years down the road, then your answer is always to invest now. So if you look what's going to happen next week or next month, nobody knows for sure. And when it comes to investing, you can never avoid losses totally. So that hopefully answers your question. Is it a good time to invest? Because yeah, you can't avoid losses in the near term, then you should look only for the long term and believe that what you buy is going to be worth a lot more down the years.
Good answer, Josh. Thank you. So maybe, do you guys see any interesting questions that you guys want to address?
I think there's a question by Calvin, which I think Josh is very well suited to answer. In 2021, will most of the REITs provide dividends?
I think they have to provide dividends. Actually, the REIT's mandate is to pay out 90% dividends.
Exactly,
so,
right?
Yes, they have to pay dividends for sure.
Yeah.
Unless they're in trouble, they have to do that.
Yeah. No, I mean, this is, I think, a very good point you're bringing up there, and I wanted to go into exactly the same direction, right? There is the great thing about REITs is they need to distribute 90% of their profits, right? And it currently doesn't look like any or like there's no major troubles that they would not make profits, and they then basically have to distribute them. The other part, another thing which is great about REITs is that there are no tax on these dividends, right? Which makes it even more interesting. Anything you have to add on this, Josh? Anything I missed?
Good enough. Good enough. I think Singapore has a very favorable REIT climate. Actually, that's my gut feel of things. Looking at Hong Kong and Australia, I think Singapore does seem to encourage a lot of REITs. That's why we'll be getting a lot of REIT listings.
Yeah, and then there's a question which is related. There's someone asking, like, the REIT market has seen a decline over the last few months, and they're asking us if it will rebound back within the next couple of months. And like, I think no one can answer this with 100% certainty, right? But I think what's the right thing, and I think Josh mentioned it earlier, is like to say, like, is the fundamentals, are they good? Do you believe in overall the sector to be growing and to do well over the next couple of years, right? And there, for me, the answer would be yes, right? Property is limited in Singapore. The economy generally is doing well. Yes, of course, there were there was a bit of the whole pandemic, of course, had a big impact on it, but overall the economy, I think, is doing well. So I think the fundamentals are in place, right? So if you would ask me, like, do I know what will happen in the next few months, I would say I don't know. A lot of things can happen, and there's a lot of impact will have how the yields, or like government bond yields will evolve and so on. But the long-term view is I would see it very positive. Melvin, any other questions?
Yes, actually, that's one. So how are corporate actions carried out in the REIT Plus portfolio? So how would this affect the overall valuation of our REIT Plus portfolio, especially without further injection of funds?
Yeah, that's a very good point. I think Josh mentioned earlier that this is one of the things he likes about the REIT Plus portfolio. So basically, no action has to be taken on as an investor in Syfe REIT Plus. This is basically all done for you. Generally, the guideline is to follow the index, right? So that is what we do. In certain cases, right, it also doesn't really make any sense to participate in a corporate action. I think we have seen this recently. Unfortunately, I just can't remember right now which REIT it was, but basically that there was no incentive to subscribe to a new rights issue, right? And therefore we haven't participated in this, right? One of the reasons why there is a certain very small but still like cash portion in the portfolio, it is exactly for this reason, right? In order to use it for rights issues and similar things.
Good. Thank you so much for the answer again. So does Syfe have any plans to change the index that it is tracking in the future, if it thinks that the index would underperform, or if there's any other better options?
No, I think we have really, like, done our due diligence when we thought about which is the right index to track, right? And so there's no plans to change the index in the future. I think the index does what it is supposed to do. So I think no, we don't see any reason why we would change that.
Okay, so maybe another one. This is actually from an existing client. My REIT portfolio is always in the negative, so does it make sense to continue as the interest received are well below the market value?
No. I mean, I think that's an interesting statement. And I think it mainly depends on when the person has invested, right? If like, yeah, it really depends on when this person has invested. I think the majority, or a lot of our clients are actually seeing very, very good returns, who have come in throughout last year, right? So in my opinion, it's my answer is very similar to this question than to the question, like two questions back, is like, I think we are very confident on the medium to long term prospects of the REIT market in Singapore. So I think I believe it's something to hold on to, and interest. So there's not real interest, but I would assume it. The person referred to the dividends, right? I think the dividends, yes, in 2020 at 4.5%, if I'm not mistaken, were a bit lower than historically. But even this, I feel it will go back up, and 4.5% is still a lot compared to what you can receive in your bank savings account at the moment, right? So I think it's still highly attractive.
Okay. So maybe what happens if Syfe stops operating? I feels like this comes up every webinar. Yeah.
I think let us maybe go through let me answer it right away. I think we have a slide which answers this to a certain extent. So I think there's two parts to this. One is only about 5 months ago, we have actually received an investment of $25 million, which basically capitalizes us for a very long time in order to run this operation. I think the second part is what I also already brought up, which is the MAS license, right? There are very stringent requirements to it in order to get the license, and where we need to show on how we can run this business in the long term, and where they get themselves some like security in order to in case something should go wrong, right? There's very high base capital requirements and similar things. But let's say it really comes to worst, and like basically Syfe would wind down the business. Even in this case, basically what would happen is, like, one, the assets of Syfe as a company and the assets of Syfe's clients are segregated, right? So in the event of an insolvency, MAS would appoint a different fund manager who will then take care of the client's assets, and depending on what the client wants, does he want to continue investing or want to withdraw the money, the clients will have this option. A lot of times we are asked, but then I'm forced to sell. One, this might not be the case. There is a very big chance that the fund manager will just keep the portfolio running. But even if you would have to, there's no brokerage fee for Syfe clients. So even in the case you're basically forced to sell and you receive the money in your bank account, you would basically have lost no money because there's no brokerage, and you could actually buy all of them, through the exchange. You'll incur some fees when you buy them again, but other than that, there's actually no downside for you. But I think most important point is what I said in the beginning: we are very well capitalized, so there's no risk that this will happen. Let us continue very quickly, just 2-3 slides, and I know it's already quite late, about how it actually works. And then we will still answer I think there's still 10 questions or so remaining. Oh no, some of them we already answered, but we'll answer the rest of the questions. the first step is basically to download the Syfe app or go to www.syfe.com, and you would go through a short questionnaire. And at the end of this questionnaire, we would basically show you the portfolio recommendation, including a forecast, historical returns, what is exactly the underlying securities of the portfolio. You can play around with the forecasting tool by changing the lump sum or the monthly deposits, the different durations, etc. And only then you actually decide, do you want to invest and do you want to create an account? If you go ahead and you create an account and you fund the portfolio, then on a daily basis you'll be able to monitor the portfolio and see the performance. Syfe, we charge a low all-inclusive fee of 0.4 to 0.65% per annum. That means on $10,000 invested, the fees would be a bit more than $1 every week, or $65 a year. And this goes even down if you invest more than that. On $20,000, the management fee is 0.5%. Above $100,000 is 0.4%. On Cash Plus, we are not charging a management fee at all. It's basic, but it also does not count to the tier. So it's the blue, black, or gold tier is not impacted by the amount of money you have in your Cash Plus portfolio. As I said, this is an all-inclusive pricing, so there's no trading fees, there's no entry or exit charges, there's no minimum balance, there's an unlimited amount of free withdrawals, so you can withdraw or also deposit theoretically every single day. And there's unlimited rebalancing, so whenever there's a rebalancing required, we will do it, and there's no extra fee for that. And one of the criteria for how so in the case of REIT Plus, there's no fees of the underlying REITs at all, because there's no management fee associated to a REIT, right? In the case of the other portfolios where we invest in ETFs, one of the criteria how we choose the ETF is that we only pick ETFs with very low management fees. We already went through this, the advantages of investing into Syfe over a DIY approach. And then I want to also invite you to reach out and talk to one of our Syfe wealth experts. There's a picture of the team, and they can really help you with your individual situation, right? And they go a bit more into details and will help you to better understand the Syfe investment options. You can schedule a call with them through our website when you go on the advisory page. That said, there is upcoming seminars. Next week will actually again be with me. Unfortunately without the guest this time, but we'll give an overview of all the different Syfe portfolios. And the week after, we have one of our very popular deep dive sessions into the investment strategy together with Richard Ye, our head of portfolio construction and risk management. That said, and we will still answer the rest of the questions, but if you're interested in a 6 months fee waiver, then I would like to ask you to scan this QR code, and you'll be, after answering 2 or 3 questions with feedback for this webinar, which we're always very thankful for, you'll be able to get a promo code which will give you 6 months fee waiver for up to $30,000. With this, we come to the end of the session, but there's a few questions left. Melvin.
Okay, so I answered most of them, so I shortlisted 4. So I think they are good questions to go through with a crowd. So I think the first one, Josh can help us with it. So what's the difference between investing in Singapore REITs versus blue chip equities? Right, there's high dividend paying blue chip equities. So should they avoid them and go for REITs, or?
I guess blue chip equities, what the attendee is mentioning, probably banks, probably telcos. But if we think about it, Singapore's context, banks were always concerned about challenge of fintech, etc., etc. So of course, our Singapore banks are among the most stable and stuff. So do you like banks? On the other hand, REITs, they do provide 90% dividends has to be paid out. So REITs, even though as a sector, pays out about the highest in terms of dividend yield. So that's something to take note of. Then the other sector that's big in Singapore, blue chip wise, typically we'll be thinking about telcos. So that'll be your Singtel and stuff. But again, Singtel's business challenges and stuff, you have to think whether they have been able to produce that level of dividend rate. Because some of the telcos have actually cut back on dividends already. So that's to answer the question. Whether it's blue chip or not, the main part is whether business operations are still going to deliver returns as well as dividends. So if you think REITs are a better sector, then perhaps this is a good choice for you to consider.
Okay, so thank you for your answer, Josh. Maybe another one, right? So the IHS REIT Leaders Index has about 40% invested into the Mapletree family of REITs. Is it too much of a risk exposure towards the Mapletree family?
Maybe I can pick it up first. Mapletree is one of our premier names when it comes to properties, day and capital land, of course. So I would much rather a good sponsor than a weak sponsor. So as we know, this portfolio tracks the IHS REIT Leaders Index. So if they underperform, naturally they'll be reduced. But I don't think too much of that risk exposure. I do think Mapletree is actually a good sponsor in a lot of ways. So if more is there, I think it's okay. That's my opinion, at least.
Yeah. No, I think I think that's exactly the reason why at least each of the single REITs is kept at 10%, right? And I think there is indeed, I think there's 3 REITs, or even 4 by Mapletree, which yes adds up, but they're also in very different sectors, right? So even if a specific REIT of Mapletree gets affected by something, that does not mean that the other 2 or 3 are negatively affected as well, right? It could even be that they maybe have a positive effect, right? As we have seen, like in this pandemic, right? There were certain sectors which were going up and certain which were going down, and there's a high chance that even within Mapletree, some will go up, some will go down. I don't see a risk that just because they're Mapletree, they will all go down. Right?
Great add-on. So thank you, Sebastian. So maybe another one. This one by an anonymous attendee. So according to the papers today, the pandemic will only go away in 7 years. How will it affect investments in general?
Yeah, so I think, in my opinion, right, and I mentioned already earlier, right, I think it's really about, a lot of it is about time in the market, right? I think the risk of waiting for 7 years before starting to invest is higher than the risk of starting today. Yeah, I think that would be my answer, and I think general, right? Humanity has proven to be very creative, right? And if it really takes 7 years, then we will find ways to deal with it in some way or form. And I think the vaccine rollout, yes, in some countries is faster, in some countries is slower, but I think we'll find ways to deal with the pandemic, and there will be maybe like vaccine passports, and I think many, and maybe we'll be even more on Zoom for the next 7 years, but we'll find ways to handle the pandemic, I believe.
Maybe I can add on a bit further. When it comes to investing, especially when you look in terms of very long time frame, now we are worried about pandemic. But if we look across history, right, there will always be a problem. There will always be some form of concern, war, trade tension, something else. So that there'll never be a green light where everything is clear and peaceful. So there'll always be some bad news. So don't let it affect too much of your decision planning. Maybe that's something I'd like to add on.
Yeah.
Great.
I think that was such a nice statement. Could also be almost the last, the perfect final for this webinar. But we have one more question.
Yes, so it is said that the price of REITs tend to be very sensitive towards the change in interest rates, right? So how true or relevant is this statement? Should we be concerned with future rise in interest rates on our REIT Plus portfolio?
The statement generally is true. There is a correlation between interest rates and the REIT market, right? I think that there's no doubt about this, but I feel it's mostly again a very short-term point, right? I think in the long term, I don't think this is I believe, yes, maybe now the interest rates went up a little bit, but they're still on a very, very low level, and I don't expect them to go up significantly anytime soon. So yes, they might have gone up a little bit over the last few weeks or months, but I think generally they will stay on a lower level for a longer period of time. I mean, now just the US just passed the new stimulus package. It will be very hard for government to increase interest rates after giving these huge stimulus packages. Yeah.
Maybe I can add on a bit. I've actually seen reports that, whether it's beneficial or detrimental, it's a bit mixed. Because rising interest rates means generally a strong economy, which means you will not have tenants leaving the REIT, leaving the property itself. If it's a shopping mall, they're not vacating a place. If it's a office tower, they're not leaving it totally. Yeah. So rising interest rate means a stronger economy. It may also be good also to the REIT. So the research have been fairly mixed. That's what I understood. In any case, if a strong economy means the REIT can actually increase their rent, so there can be a lot of things that can affect that sentiment. So it is not a plain blanket. With interest rates rising, it's bad for REIT. I think we can see things both sides also. So maybe that's what I'd like to add.
Perfect. Thank you, Josh. Great. So I think with this, we are coming to the end of today's session. Josh, thank you very much for staying with us for so long. I know it's already very late. It was a pleasure having you here. A lot of great answers. I hope we'll be welcoming you back here sometime again.
Yes. Thank you. I had fun also.
Great. Then I think for all the participants and who spent an hour and a half during dinner time, as Josh mentioned earlier, really also appreciate you spending your evening with us. And I hope to see you in one of our upcoming webinars sometime soon. Great. Thank you. Goodbye.
Okay. Thank you. Bye-bye.
Great listening ahead. Cheers. Bye-bye.